I think we have to first recognize that it's taking too long for inflation to come back to target. That means that central banks will have to remain committed to fighting inflation, even if that means risking weaker growth or much more cooling in the labor market than we've seen so far. The second uncomfortable truth is that when you have financial stresses, it could lead to tensions between central banks' price and financial stability goals, right? So in principle, you could have separation, but in practice, it can be pretty complicated. And the third uncomfortable truth is that central bankers are likely to face much more upside risks to inflation than they did before the pandemic. And that's for multiple reasons, including the fact that there's likely to be more supply-side shocks of the kind we've seen, because we're moving into a world that's more fragmented than we were used to before. Climate transition could pose some risks. And also what we've learned in the recent time is that the relation between output and inflation, the so-called Phillips curve, is not that flat. So I think they're going to grapple with a harder problem.
Let's perhaps pick one point that here on the ground, that people tend to think that it's better to err on the side of caution to hike rates into more restrictive territory. Would you say that's a good strategy?
I think we have to recognize that we are in very uncertain times. We also have to recognize that central banks have done quite a bit. And the ECB has raised interest rates by 400 basis points, which is the most it's ever done. So there's quite a bit of tightening in the system that's coming through. But that said, we do think that they should continue tightening. And importantly, they should stay at the higher level for a while. Now, this is unlike, for instance, what several markets expect, which is that things are going to come down very quickly in terms of rates. I think they'll have to be on hold for much longer.
What would you say are the negative side effects of that policy? Because clearly pockets of the markets do already feel it. The consumer does feel it, at least some parts of the market. What's your major concern?
Well, we should expect to see slowing in activity. If anything, I think what we are surprised by is how resilient economic activity has been. Up until now, in terms of, if you look at measures of consumer confidence, these are still strong. Labor markets are still very tight. Unemployment rates are at record lows in many countries that we're looking at. So, in a sense, given all that's been done in terms of the energy shock, in terms of the tightening of policy, it's a bit surprising how resilient the economy is. Now, we are seeing signs of slowing, as it should, which is what we need to be able to bring inflation down. But our projections and ECB's projections are for inflation to get back to target by 2025, middle of 2025. That's 2 years from now. That is a long time. And we worry about inflation dynamics changing, which is why we think that it's better to continue tightening now and then stay on hold.